A lesson on business finance and accounting, we came to the offices of George Stamaroff, MBA and CPA. Following a distinguished career with the Internal Revenue Service, he founded his company to provide accounting services and financial advice to highly successful businesses and entertainment personalities. We asked him to start at the beginning, to explain who owns businesses and how individuals take possession of businesses.
Well, the simplest form is a sole proprietorship. That is where one individual owns the business in an unincorporated form, and there's no legal distinction between the business and the owner. There could also be a partnership where there are two or more partners, and that is a legal entity. There could also be a corporation, and that's a separate legal entity that is formed under the state law. And the corporation can be either a subchapter S corporation, which is a way of taxing the profits to the owners, or it can be what's called a subchapter C corporation, which pays its own tax.
What are the advantages and the disadvantages of a sole proprietorship and a partnership?
Well, the advantage to a sole proprietorship is that it's easy to form and easy to terminate because there's no legal requirement to file any papers. It costs less money or no money at all, and you are a sole proprietorship by default. And a partnership does cost money to form, usually through a partnership agreement, and you have a sharing of profits and losses. A corporation also involves some cost to form, and a corporation has limited liability.
All right, so talk to me about what are the negatives associated with the sole proprietorship?
Well, the same thing that's positive could be a negative. For example, if the business is sued, then the personal assets of the owner could also be exposed to any judgments.
Okay. And what about a partnership?
A partnership is the same way, unless it's a limited partnership. Most operating businesses, however, are not limited partnerships, and they're general partnerships, which means that the partnership assets can be subject to a judgment, as well as the individual assets of each of the partners. Every partnership has to have at least one general partner. Now, the limited partners typically would be passive investors and not active in the business, and limited refers to their liability for any losses or damages or judgments. They're limited to the amount of money that they have given to the partnership, so they can't lose any more than that. So that is a limited partnership, and those typically apply to investment deals, maybe real estate.
What would most retail businesses be?
Well, I'd say the greatest number would be sole proprietorships, partnerships, or corporations. And that depends on the business, its tax structure, how long it's been around, whether there's any planning done by the owners. But a typical business would start out as a sole proprietorship, maybe become a partnership or a corporation, and continue as such until the business ends.
Explaining exactly what a financial statement is, the components that go into a financial statement, and then briefly explain each.
Well, a financial statement refers to a balance sheet, a profit and loss, or an income statement, and a statement of cash flows. A balance sheet can best be likened to a snapshot on a particular point in time. So on usually the end of the year, it's what a company has, what it owns, and what it owes, and the difference being its equity. An income statement is like a moving picture. It shows what happened during a period of time, typically 12 months, and it shows what flowed in, what was paid out in expenses, and what was left over as profit. A statement of cash flows shows what happened to the cash, how it was generated, how it was spent, what the beginning balance was, and what the ending cash balance was.
All right, George, it's time to begin discussing those various components of the financial statement. Let's begin with the balance sheet, and let's go to the screen. Take us down current assets and explain the items we see.
Assets, of course, are everything that the business owns, and current assets are defined as assets that will be realized into cash within a year. So current means less than a year to collect them.
Current assets, we see cash on hand, cash in bank, accounts receivable, prepaid expense, but inventory. How is inventory generally carried on the books? Explain that.
Well, it is what the business has paid for it, and all the figures on the balance sheet are what's called historical cost. However, there are different assumptions in valuing inventory. When a physical count is taken, the inventory can be priced at what's called FIFO, which is first in, first out. It can be priced at LIFO, which is last in, first out. And in a period of rising prices, let's say that at the beginning of the year, your item costs $10, and at the end of the year, it costs $15. Well, LIFO says or assumes that the last item in, the $15 item, is the one that went out the door, and therefore your cost of sales is higher, and your gross profit is lower, and your profit is lower, and you pay less taxes. So a lot of businesses elect LIFO to pay less taxes.
So then, by adoption of one of these various methods of valuing your inventory, you can actually legally manipulate your taxes.
Yes, you can, and your income.
All right, let's go back to the screen, and now we see fixed assets. Could you explain each of those to us?
Well, fixed assets consist of land and building, and fixtures and equipment, and then the subtraction from that is accumulated depreciation. Now, accumulated depreciation is the total that the business has deducted over the useful life of these assets.
I don't think that most people fully understand depreciation. Somebody once explained it to me as it's a gift from government. Give us a crash course in depreciation, please.
Well, that's one explanation, but it's not a gift, it's something that's paid for. The cost of the item is paid for, and it's either paid for in cash or a combination of cash and a loan. So let's say, for example, that you buy a building. Now, the government says, we recognize that the building wears out. Now, even though real estate may historically appreciate in value, both from a financial accounting concept and from a tax concept, depreciation is allowed as a expense on the income statement to recover the cost of that asset. So it's a non-cash expense, but it is based on the purchase price of the asset. So maybe in year 2 or 3, after the item is paid for, assuming a cash purchase, there's not going to be any more cash outlay, but the expense gets charged, and it's a book entry. And it's based on an estimated useful life. So the cost is divided by the estimated useful life, and that is the resulting figure that's allowed to be deducted.
Okay, help me out here. Help me understand. I'm in the office supply business. I go out and spend $10,000 on fixtures to display goods and merchandise within my store. Over what period of time can I depreciate those?
Well, the most common life is prescribed by the tax code, and those are 5-year property. So you would be able to deduct those over a 5-year period.
All right, so then what you're saying is, if I go out and spend this $10,000 and buy this equipment to display my merchandise, I guess I basically get to depreciate it over 5 years. It's tax deductible.
Yes.
Well, now let's look at the other part of the balance sheet, and that's the liability side. Now, the first thing we see are current liabilities.
Well, current liabilities are all of the bills that the business owes that are going to be paid within a year.
Mm-hmm.
So, for example, accounts payable, trade, that's what they owe their suppliers for the merchandise that they bought.
Mm-hmm.
Federal withholding, FICA tax, those are payroll taxes that they owe the government on wages that they paid. Sales tax payable as well. So those are the most common items that are in current liabilities.
All right, then that next category we're seeing here is long-term liabilities.
Well, long-term is everything that's paid longer than a year. So that's owed in year 2 through whenever.
All right, now this third category here, equity. Would you explain each of these listings here?
Well, equity, first item is common stock. That is an amount that is paid for the stock, or if the founders have contributed money to buy the stock. Retained earnings is a running account of how much the business has made in profit since it's been in business, since the beginning. And subtracted from equity are dividends that have been paid out. Those are distributions to owners. In a small business, it's not very common to have it pay dividends. Most of the time, the owners take a salary for tax reasons because dividends are double taxed. And current income is what the business has made this year as net profit. So total assets minus liabilities equals owner's equity.
There must be some rules of thumb, or there must be some ratios as to what people look for in determining a business's health by looking at their balance sheet?
The first thing to look at is working capital, and that is defined as current assets minus current liabilities. So you want to make sure that the business has enough cash and they're going to collect enough money to operate. So working capital should be a positive number.
So in the example that we've been looking at together, the business has total current liabilities, well, in fact, you can see them right here, total current liabilities of $96,000 and total current assets of $157,000. I mean, is that good?
Well, that's healthy because 157 minus 96 means that if the business closed today, they could pay off all of their bills and still have money left over. So that's good, and the current ratio, which is the ratio of current assets to liabilities, should certainly be more than 1, and in a very healthy business might be 3 or 4, or even higher.
Okay. What other ratios?
Well, the other ratio to look at is, or the other thing to look for is that there is a positive owner's equity. That means that the owners have not taken out all the profits out of the business. There are other operating ratios, for example, the inventory turnover ratio. You would take your cost of sales and divide it by your average inventory and see how many times items have turned over. In a healthy business, the turnover is higher than in a non-healthy business. That means you're selling items, you're buying them, they're moving out the door, you're doing business.
Take us through an income statement.
Well, the first item is revenue, and listed here are various categories of revenue: furniture, supplies, printing, forms, catalog, other, and then there's total revenue.
So we can see for the month, they've done $133,000 in business.
Right, of which 87,000 is sales of furniture, 24,000 is sales of supplies, and so forth.
Okay. And then what occurs underneath that? Explain cost of sales.
Well, cost of sales is the cost of the product that generated the sale. And in this case, there's one line item for cost of goods sold and one line item for freight.
All right, so now gross profit, that's what you get to keep, right?
No, that's not what you get to keep. It's that's the gross profit that results from the sale of the product, but you have overhead expenses.
All right. And talk to us about those operating expenses, and as you do, or before you do, explain for us the difference between fixed expenses and variable expenses.
Well, sometimes you don't see the distinction on an income statement, but a fixed expense is one that you have to pay for whether the business does any business or not. For example, rent. A variable expense is one that varies with the level of sales. For example, supplies. If you sell more, you use more supplies, your expense is going to be higher. What's more commonly seen on an income statement is an administrative expense or a sales expense or some category such as that.
All right, briefly take us through, George, the operating expenses we're seeing on the screen right now.
Well, these are listed alphabetically in this example. So we have accounting, advertising, auto and truck expense, bank charges, credit card fees, depreciation, which is shown as an expense but may not involve any cash outlay, insurance, interest, miscellaneous, postage, repairs and maintenance, officer salaries, other salaries, payroll taxes, other taxes, telephone expense, utilities, and warehouse.
So then what do you do with the total expenses?
You subtract the total expenses from the gross profit, and you have your operating income as the difference. And hopefully that's a positive number.
And so that is the income statement. And how often do most businesses do an income statement?
Most often, they do them once a month.
All right, and that brings us to the statement of cash flows. Explain that conceptually for us.
Well, a statement of cash flows tells you where the cash came from and where it went, what generated the cash, how much the cash increased or decreased, and what the ending cash is. The first section is cash flow from operating activities. So you start with net income, and then you add back other adjustments to reconcile cash flow. There's depreciation, it's a non-cash expense, but it was included in the net income figure, so it's added back. You have your gain or loss on asset sales.
Now, help us out. The final 4 lines on our cash flow statement. Cash provided or used by financing, net increase or decrease in cash, cash at the beginning of the period and cash at the end of the period. Shed some light on those.
Well, you have to look at them in context with how much cash was provided by operations. So the business generated cash of $257,000 in round numbers. They spent cash on equipment purchases of about $56,000, and they used the rest of the cash to pay down some debt and take money out of the business. So this gives you a complete picture of where the cash came from and where it went. The cash decreased by almost $20,000 between the beginning and end of the year, and it shows you what the cash was at the beginning of the year and what it is now.
We now understand the three components that make up a financial statement. But in many respects, they seem to be interwoven, as though you would need all three to get a full read on the business. Is that correct, or could you look at just one of them and determine the health of a business?
The two statements that have the most emphasis, I think, are the income statement, which shows how profitable the business is, and the statement of cash flows. The balance sheet is important, but by itself doesn't really give a complete picture of the business. It doesn't say what is happening on an ongoing basis over a period of time. It's just a snapshot. It's a one-day picture, and the balance sheet can be improved by some manipulations. For example, cash can be used to pay off debt. You can increase your current ratios. So what's more meaningful and important is how much the business generates in net income and in cash flow.
Welcome back. It's time to learn about the fascinating concept of incremental sales increases. What constantly amazes me is that virtually everyone in business knows about incremental sales increases, but very few people in media or advertising understand anything at all about it. Now, here's what it means. Incremental sales increases simply means that once a business's revenues have covered their fixed costs of operation, a disproportionate amount of the additional revenues they achieve falls straight to the bottom line. And it provides them a lot of money to be able to do things with. In your case, spend some more money on advertising. Come on along to my chalkboard. Let me give you an example of what I mean. For purposes of our illustration, we're going to assume that we have a clothing store. And we're going to pretend that the store is doing $4 million a year. Now, the numbers I'm going to use are easy numbers just so you can grasp the concept. Now, let's take a look at what would happen on the expense side of the ledger if this store was indeed doing $4 million in annual sales. First of all, it's probably a safe bet that their cost of goods sold would be somewhere around $2 million. So let's subtract that, take it away. That would result in a gross profit of about $2 million. Now, there would be some additional expenses off that, of course. What would their fixed expenses be? Well, let's make a guess, and let's say that their fixed expenses would total about $1 million. Fixed expenses are those expenses that don't change. The heat, the light, the telephone, the rent, the wages. Fixed expenses don't change, they're just there. Now, let's go to the next step, and let's assume that their variable expense items are costing them about $500,000 a year. Do you recall what variable expense items are? Those are the ones that change with sales. They have a direct relationship with the revenue line up here. The best example of a variable expense item is probably sales commissions. If the sales go up, they go up. Finally, let's further conclude that our hypothetical clothing store is spending, let's say, $200,000 a year on advertising. Well, if you add up the cost of goods sold here, the fixed expenses, the variable, the advertising, it'll total about $3,700,000 on that $4 million, which would leave our clothing store a net profit pre-tax of about, let's put it up here, of about $300,000. Now, that's not a bad little business. But now, let me ask you another question. If you were meeting with this clothing store owner or decision maker, and you asked them what they'd really like to be doing in terms of annual revenues, and remember, everybody did start out in business with a dream, what do you think they'd say? Well, 99% of all business owners I've met with want to increase sales. It's a natural condition. Everybody always wants to do better. Well, with your prodding, what do you think they might tell you? Well, for purposes of our example, let's assume that following some give and take, negotiation and discussion back and forth, the store owner or the decision maker tells you they'd like to increase their sales by 25% to, and I'll use a different color chalk here, to, let's say, $5 million a year. Now, that's not that hefty. There are many businesses that routinely want to and are able to increase sales 25% per year. But now, let's take a look at what happens on the expense side of the ledger again. First of all, what about the cost of goods sold? Well, using that same roughly 50% markup for purposes of example, it's a safe assumption to conclude that this business's direct cost of goods sold would be about $2.5 million. What about their fixed expenses? Well, remember, that's the beautiful thing about fixed expenses. They really don't change. They'd probably stay right at about $1 million. Well, what about the variable expenses? Well, you'd have to figure out how much their variable expense items would increase, but if they were primarily commissions, chances are that instead of being $500,000 as they were in the example over here, they'd probably increase somewhat proportionately to, let's just say, around $600,000. Now, remember the $200,000 they spent on advertising last time? Well, let's leave that in there. And I want to leave one other thing in there, and that's the $300,000 that they've already earned in profits from our previous example. So now, let's run a total. We've got 3.5, 4.1, 4.3, 4.6, total expenses of $4,600,000 would result in an additional, and let's see, where can I put it? I guess I'll put it over here for you, an additional profit of $400,000. Now, added to their previous net profit of $300,000, this store would be earning $700,000 a year. That's just based on increasing their revenues from $4 million a year to $5 million a year. Now, consider for a moment that additional $400,000 over here. And let me ask you a question. If you were a store owner who had a chance to increase your revenues from $4 to $5 million and bring in an additional $400,000 in net profit, how much of that might you be willing to invest in advertising to make it happen? I don't know the motivation of our hypothetical clothing store decision maker, but I know this. There are many stores, many businesses, who would find it prudent to spend as much as half of those increased profits in order to increase their revenues and thus increase their net profits. So hypothetically, here's what you need to consider. They were spending $200,000 in advertising, we left it in over there, to achieve that first $4 million in sales. It may very well be worth to them, depending on their motivation, a couple of $100,000 extra dollars just to increase their revenues by 25%. Now, this is where you have to make a big decision. Are you going to be one of those individuals who's out there in the marketplace fighting for a little share of an existing budget? Or are you going to be one of those people out there trying to create brand new budgets? Come back to my magical chalkboard for a moment and let me show you some other numbers. Now, this is an overview of the share of the advertising pie that's taken by some members of the media. For example, let's consider newspapers for a moment. Newspapers get about 22% of total advertising expenditures as of the year 2000. Television gets about 19%. Radio is in there at 8%. Cable is taking about 5%. Direct mail takes about 20%. And the internet, well, you know, it's tough to come up with a number for the internet because it's growing more than 150% annually, according to a recent study by McCann Erickson. Remember the $200,000 that the clothing store was spending to do the first $4 million in sales? Well, let's take a look at it. Chances are that newspapers would be getting about $44,000. Not bad. The television would be getting roughly $40,000. But now there's only one problem. There are probably somewhere between 3 and 5 television stations chasing that $40,000. Now let's take a look at radio. With that 8% share of the revenue pie, the total radio spend would be what? About $16,000. And yet a question, how many radio stations would be fighting to get that $16,000? Well, I'd bet there's somewhere between 5 and 30 different radio stations fighting for that $16,000 annual figure. There's little question as to why television and radio people have to be out in the marketplace being commodity salespeople, giving away free spots, value-added bonus spots, doing whatever they can to reduce their price to get their little tiny share of the advertising spend. In the case of cable, if they just take their fair share, it's almost insignificant. They'd be picking up about $10,000 a year. In direct mail, not bad. They'd end up with about $40,000. Let me explain to you what your choice is going to be. Your choice will either be to go into a business and fight for a share of an existing budget and slug it out with everybody else for your particular member of the media's fair share, or the alternative will be to help the business decision maker or owner identify what they want to do in terms of incremental sales increases, and then take that entire additional advertising budget that you've created. What's the purpose of business? Well, you're going to have to decide. I know, sadly, what most media salespeople will do. They'll believe there's a real budget there, and they'll go in and fight for their little share of the budget. And they'll end up selling spots and dots for a long, long time. Alternatively, I know what real successful business people and deal makers are going to do. They're going to help business decision makers envision and imagine what might be and help them decide where they want to take their business. Then they're going to help that business achieve incremental sales increases. In the process, they're going to create big, substantial advertising budgets to go along with it and figure prominently in the life of the business owner. And that's your Chalk Talk and some thoughts on incremental sales increases. I'll see you for the next lesson.